Do these two candles mark the end of selling in March? Hello, ladies and gentlemen, and welcome back. Well, a lot of people are left scratching their head after such a huge, ferocious bullish move in the last two trading days of this week. But more importantly, we have to focus and look at the real information at hand. Do we still have unfilled gaps in key zones? Absolutely. And could we still turn to a new sell-off low? It's all possible, so let's talk about it right now. So welcome back, everyone, to a very special edition. We're going to be focused in here on bonds and stocks today, and then we'll be resuming our normal show throughout, of course, the next video we put out on the weekend. But I want to talk about high yields to start off with. Now, many people would know we've been looking at high yield junk bonds, and when we're seeing those sell off, we're getting scared in the market, and when we're seeing them resume with the stock market at the same time, we kind of give it a tick of approval. We've seen two fairly strong days on junk. But then we move over to treasuries, and this is where the story starts to become more clear. The first thing that I noticed with treasuries is that we got a huge gap in the morning. Now, this is something that I've been looking at very closely. I'm obviously a bit of a lover of treasuries around this zone. I think the risk reward is very interesting. We've seen increased volume, and there's really only two times that bonds, especially treasuries, tend to go up. Just before people realize they need them, and of course, when people think they suck. Now, in 2018, people thought they sucked and they had some of the best years at the end of the cycle. That tends to be when treasuries do well. The other time is if a recession is coming and the market starts to smell it out. Now, if we see this, we tend to see treasuries go up because what happens? The US 10Y tends to go down. And something happened over the last 24 hours that was very interesting indeed. So what does this mean for treasuries? Well, since they came back down, we saw a gap below and we saw an incredibly strong out of market performance. Basically, the aftermarket into the next open was a huge rally. 2.42% was how much treasuries put on. It actually beat the S&P 500 and most other indices for the day. Now, we had this kind of signal before. We had one over here at the beginning of 2023. It doesn't necessarily mean it's going to rally this much, but it's very interesting to see the treasuries swept the low, which was here, got into our key zones, and then started moving forward. So treasuries definitely a tick up in terms of what's moving on. But now let's have a look at yields. So the big story this year this year so far and really this month has been US 2-year yields. We've seen inflation showing bad signs, and at the same time, we've had US 2-year reaching a new high. Now, this is, of course, a critical point, and we may see US 2-year kind of decline depending on the jobs numbers this week. But where the big move on the markets were on the Friday and Thursdays were actually US 10-year and 5-year. Here's the 5-year, you can see the drop, but take a look at the 10-year drop off, 2.61%. Then we go to the 20-year, which dropped 2.77%. And then we go to the US 30-year, which dropped 2.98%. So what this is telling us is that we are now very much going back to new levels of potential high inversion. Now, many people will know the US 2-year versus US 10Y, or the 3-month versus the US 10Y, traditionally show us a recession is coming. And the higher that these are inverted, the more sure the bond market is that that will occur. Now, timing's everything. So just because the bond market believes a recession is coming, they're often 12 to even 24 months early. And remember, we're only in month 11 to 12 after the first inversions really started to appear. So although a recession may come in the US, what this is showing us is that it's getting a little bit scary. We're about to reach new highs on this inversion. This also means that if we see the US 10-year and 20-year start to drop off, what's that telling us? It's telling us that the stock market, or at least in this case, the bonds market, the market itself, is seeing weakness in the future for the US economy. Remember, these are controlled by the market itself, and the US 2-year or 3-month is considered controlled by the Federal Reserve. They control the short date. The market says whether they agree with them or not. So this was a big change in the Friday session, and it led on to those treasury moves. Now, does this mean that the rallies are real and everything's great in the markets? Well, let's have a look at some of the data that we found. First up, we'll look at the federal terminal rates. Nothing much changed here. We did see US 2-year go down slightly, but overall it's still around 5.5%, which is where we expect the Federal Reserve to, at the moment, hit terminal rates, and then cuts are coming through at a lower pace than they were late last year. Let's have a look at the next bit of evidence, which is obviously the seasonality. Now, a lot of people really were banking. I can see it in the comments down below, and I want to kind of explain this. So they were banking on this exact chart. Now, this doesn't mean it's going to be exactly like this. Seasonality is a tool to attach to your technical levels. Remember, if you were looking at 4,000 or 4020, which are definitely some key levels we'll look at in the future in this video, then those zones need activation. Did we see the correct activation around those levels? We'll talk about that. So can it rally and then still dump during March? It's very possible. And then, of course, it's still very possible that we get a March into April sustained rally. These are the times that you tend to see sell-off. So far, the market's done what we talked about, which was, of course, the middle of February. We saw the sell-off. Will we get new lows, though, from this point? Well, let's talk about it soon. Volatility for the S&P 500 really hasn't spiked to its historical highs. Q1, Q3. Always remember that in the stock market. The two most seasonally volatile times, along with April, May, June, into July being kind of the calm before the storm. If you see nice bull markets around that period and markets are getting super FOMO-ish, then usually it means that August, September, and October, those months are going to be where you need to be most careful in markets. So let's now have a look at the market themselves. Let's go over to the Qs to start off with. So I've marked up here the expected weekly options highs, just so you can see where the market ended up closing. Now, there are some calls that we'll take a look at, the 4K calls that were on the SPY that got paid off. Did they really get paid that much, though? Probably not. And you've got to remember, guys, that not every single call wall or put wall will be respected. It's the third week options expiration, the OPEX then, that tends to be the one you should focus in the most with call and put options. And that's what we always focus in as much as we can. I still bring it up during the week to week, but it's only a tool to add along with your confluence. Remember, confluence is key. Find as many reasons as possible. So these are some of the unfilled gaps that we're seeing here on the Qs. And notice we've got two that are coming up very, very soon. Now, because of the strength of the close, this is the strength of what Wall Street did. You have to believe that at the moment, drop-offs during the session should be met by bullish demand. You don't tend to see strong closes like this not have some follow through. So there still could be a little bit more pain to come on the upside, but interesting to see where the Qs did end up close. Never forget the monthly one as well. Even when you've seen this one in the past, notice what markets did. They rallied. In this case, they actually made a new high, and they still managed to dump off in the next month back down. So markets are sneaky. They're willing to do this. I wouldn't freak out too much yet. Let's move over to the futures now. Here's the monthly just to bring the point up. And obviously I had two major watch reaction levels. We had this one down here, which got that bull party, I guess, started. And we had this one right here, which I am absolutely going to say was where I expected bears to potentially commit throughout the session. So how much did they manage to break that session, that actual area by? Well, we'll look at this when we look at the SPY, but the two key levels that most people would have been focused in on were these two here. So we have the 12,220, and of course, then we've got these highs here at 12,135. We saw most of this happen in the pre-market. We got the news that obviously came out, dropped off, and then we basically saw it rally into the end of the day. Now that we've closed above both of these, we can kind of solidify that there's a real chance to go to the next fill zones. So we'll use the S&P 500 to find that zone. But let's have a look at the 15-minute chart. Was there any point in which most people, anybody, was going to be able to trigger shorts here? There was no short build on the Nasdaq. Traditionally, when you hit these critical zones, and don't get me wrong, I think this was a critical zone that you should have had on your charts, we didn't see any higher highs, lower low, or any switches on the smaller time frame. So I'm on a 15-minute here and there wasn't anything there. Let's go down to the 5-minute and have a look at it. Again, no significant switches. So it was just basically rally, leaving behind people that are shorting zones. Make sure you have proper triggers. It's really important to have your triggers set as much as you can. Let's move over to the SPX now, because this is where really you should be focused in on. So we know the 200-day moving average held. If you follow us over on Twitter, links in the description down below, you'll notice that I posted a chart. In fact, I'll bring it up for you guys now. Let's do it. And this chart here showed the importance of the 200-day moving average. even more important when you think about it when you've had that 20% decline. Now, this chart is pretty damning for bears. There's no doubt. Like, you look at that and you go, wow, that's a beast. Like, I mean, every single time, literally in history, it's marked 3 months later being a bullish market, 100%. Now, that doesn't mean that it always will work. I mean, statistics can be broken, but obviously this is a very, very, very strong, probably data cherry-picked kind of bit of information. I mean, it's after 18 days trading above 200-day moving average with the 20% decline. But still, it does look bullish in comparison to a lot of other things. Let's move over now back to the SPY though. So I want to focus in on the close. The close was bullish. There's no doubt. It closed on its high. The previous one basically closed on its high. In the bear case, the good news is it left behind a gap. And it left behind a gap. It closed above 40.27, which we'll learn how important that was. And then we're moving towards this unfilled gap zone right now. So where do you think the bears might rejoin? Well, it's a very possible scenario that they rejoin somewhere around 40.80, 40.90 zone. So again, would that be consistent? Well, we have a close on the high. We have the expectation that markets could continue to bull. So it's certainly very, very possible. Is this still out of the question? I don't think it's out of the question yet. But what happens here will probably be very, very important. And the extreme zones here, and then obviously you get past that. Let's talk about 4,300, 4,350 at that point before bears can even consider resuming back into this particular trade. So let's move over now to the SPY. How did the SPY fare? Well, here are our expected weekly options highs and lows. Subscribe to the channel if you like this stuff. We will have a video out again over the weekend. I'll do 2 this weekend with the new expected weekly options highs and lows for all the stocks, including Tesla, Apple, SPY, Qs, etc. So don't worry about that one. We've got you covered there, guys. So we saw this hit the expected weekly options highs. Okay, just another good target, I guess. It just shows you, again, it's a confluence technique. Let's get into the nitty gritty of it all, though. We've got up here the US 500 futures. And on first glance, you might say, well, this thing looks absolutely insane. So there's a few things that certainly are very, very, forced, and we need to make sure we make sense of all of it. The first thing that happened was it came down to hit the 61.8 fib of the low to the high swing. Now, you'll see that I use this fib again when we go from the high to the low swing. Now, I've been playing with a lot of different fibs here, and initially I had a fib from this swing high down to this swing low that I thought brought us into this confluence. But it turns out that the market's actually produced a pretty interesting high to low swing, which actually would put a 61.8 fib right on all of those unfilled gaps sitting at 40.80, 40.90. Again, strengthening the case that we should fill these gaps and that this could be where the bears sit in the market. Can we find any other reasons to potentially be in this trade, though? Well, if that does occur, we could also load a volume profile for this swing so far. And what you might notice is there's this potential extreme hit where the market goes even more and it does this and something like this. So it could go bang, sell off initially, rally one last time, and then do that. Now, if that occurs, it will freak everybody out in the markets. You have to be prepared for these scenarios. Again, play it like chess. So this is still a possibility. I think this is the critical level to be focused on, but it's the way the market interacts with that zone that will give you edge or not. Remember, I really do say it here on the channel, patience, react, don't predict as much as possible. It doesn't mean that you were completely correct about taking a bull in the Friday trade. Maybe you were, maybe you weren't. But even if you were looking at the key levels we'll focus in on, you still had to see switches there. You still had to see some kind of systematic market telling you that it's going around. Now, remember, having to pick the absolute perfect level is usually what you do when you first get into trading. You pick this perfect level. You think, I've got the perfect zone. Most advanced traders, most pros that I've ever spoken to, they don't get the bottoms or the tops perfectly. Instead, they recognize the switches in trend. And there's no doubt that this is currently a pretty decent switch. I mean, we had some supply here. The market has taken it out. Where do we know critical zones lie? Right here. Where do you give up on that idea? When you get above that zone. And then, of course, at that point, you just give it up till it moves to the next level of equilibrium. So markets made a new higher high. I obviously had watch reaction here. Let's have a look and see if we even got a reaction to that zone. Just because I have it, I believe it's a critical zone, but did we even get a reaction to it? Not really. I mean, that's very minimal. Absolutely nothing happened there. The markets just shredded every single one of the key zones. So the first up one that we were using was, of course, 4,000. We got above, then we came back down. We didn't get back below. If we'd gone back below 39.90 at that point, or of course 39.70, I believe the markets would have absolutely got decimated. That's not what occurred. The markets rallied through that zone. They then absolutely shredded the 40.10 to 40.20 area. So 40.27 closed above. So what does this mean for markets moving forward? Well, again, it probably means, considering the daily close was quite strong, that markets maybe, and look at the futures. I mean, the futures really came through with the goods. It probably means that this is like a relief rally for what was a pretty aggressive sell-off. I mean, remember, the markets basically sold. We had so many days on the SPX down. I think at one point it was like 7 days down. So again, a rally up until this point is not unexpected during these times. It's what happens in here that will be critical to defining the next components of what the market does next. Is it still possible to come down to these major confluence zones and the most traded zones that we had in the market, or even the 61.8 of the whole pool? Absolutely. And I still think this is where the biggest money lies in terms of the buyers could be committed in there at a pretty high rate. But you can't deny that this came through with the goods. Let's take a look at the weekly close here. It closed on the previous weekly close. So again, fairly bullish signal, took the low, swung it. I wouldn't blame people for being bullish off that, especially with the 200-day, technique, or the systems that we saw there with the data. It's pretty good. So let's now go over to some of the other things that are moving. So first up, we saw gold. Now, gold absolutely loved the US 10-year. It was the US 10-year all day. Once we saw the US 10-year getting smoked, gold's going to go bullish, guys. And that's exactly what happened. The US 10-year is actually the most important interest rate in the markets. Nothing really matters past the US 10-year, except for when the Fed's doing its little dance. But let's face it, the Federal Reserve doesn't know what they're doing in comparison to the market that understands a little bit better. So US 10-year was down. Gold broke through this supply here. So you can see, again, reactions to this were okay. It did react initially. We didn't get a significant switch. I think there were even decent shorts actually in there, and for a scalper during the day. This one actually did get reacted to. So if you have a look here, you got nice little reaction, and you see this kind of like little breach through, pulls back, rallies up, beautiful sell there. And certainly it was a great little sell if you're a scalper. However, then you busted it again. Once it busted, no second reaction, then you were through. So what does this mean for gold for the week? Well, we've got a weekend video still coming out, so I guess we'll save it for there. But it's more than likely gold will want to move to the next level. And of course, we do have a stacked zone coming up into 1870, which we'll focus on in that video. Let's move over to the dollar index. It's in Chop City. We saw that 105.25 be reached, which was our critical zone literally a week ago. And now we're basically in buy, sell, buy, sell, buy, sell. This tends to happen when you're in consolidation after the move of equilibrium. So the move happens. We know it's going to here. It does so pretty quickly, chops up for a while, builds a position, whether that's a distribution towards the sell or an accumulation towards the buy. We don't know yet. But of course, dollar index wouldn't have liked the US 10Y going down. That's why it's down on the day. US 10Y, very, very important to these overall moves. The dollar index will be also heavily moved off the 2-year though, and the 3-month, because of course, if the Federal Reserve makes the short date really, really exciting, then it becomes more desired for at least those term deposits and money in the bank. Let's move over to the options, because I think this is where people can't handle it in some ways, and I totally understand. So of course, my expectation was we would stay between 400 and 390, two pretty big walls. We saw these calls come through literally on the Thursday, so they were part of these new kind of 0-day operations, expirations kind of thing. So because we know these came in, you could make a case for 400 to maybe even 402 potentially being respected through the session. Obviously, that wasn't the case. The markets went above and they paid them out. This is not a third week options expiration. It is a tool to go along with the extra concepts. So yeah, look, it's possible that it goes through. Remember though, the third week's the one you should be looking at. So the 17th over here of March. And this is where it's very difficult to be a bear heavily into March, into the back end of March. Because look, I mean, how can you be a bear into so many puts? This is when the real money's out. Look at the size difference. And this is still many weeks away. Totally different scenarios in terms of payout structures. If we look at the 10th for the week ahead, again, we've got some 395s and 380s. They're not big. I mean, they're 50,000. They're not huge in comparison. The call side, I expect that to probably rise through the Monday trade and the Tuesday trade, especially if we find further bulls to the 40, 80, 40, 90 zone. But again, what's becoming kind of the fought over area here, it's 410. And I expect some calls to be open through the Monday session. We've got more on that in the weekend video that we're bringing through. Do remember, if you don't watch that one, that you will need to be aware of all the news coming through. There's a couple of different central banks. We've got Fed Chair Powell being annoying on Tuesday, March the 7th. I'm sure he'll say we're going to do whatever it takes and keep saying the same thing. Then we have March the 8th. And again, we have a bunch of different big things. Fed Chair Powell talking again, JOLTS job openings. He's going to come out and cover stuff. The first number for the unemployment. And then we keep scrolling through and we get the non-farm payrolls. We also have daylight savings changing soon as well. So these are the non-farm payrolls. We know those jobless numbers matter. For the bears out there, what are you looking for? Well, you're basically looking for people losing their jobs. I mean, let's face it, that's one of the big reasons or the big things that we end up going bad. And unemployment generally will spike about 6 months out from a recession. I don't even know if we're close to 6 months out from a recession yet. That's, of course, speculation. At the moment, the markets are what we would call kangaroo, up, down, and all around, and kind of difficult to read in 2023. If you enjoyed this video, then, of course, subscribe because we do put out even longer videos that cover so many other markets. This was just a little special edition for the community because I did see some of your comments out there, and I thought, look, I better release this. Were we right about the Friday session? Well, probably not. I mean, obviously, I thought the markets would rally into the open, but what I didn't think was that we would crack 40.27 so easily. It was like butter, and the markets wanted to move through. So next big levels, 40.80, 40.90. Make sure you've got your, of course, systems in place to actually know when trends change on the smaller time frames. It's really important. And follow us through the socials if you're interested in everything else. Good luck out there, and have a great weekend. We'll see you in less than 24 hours. Bye for now.